want to start with a 30,000-foot view of retirement plans and plan design to maximize the tax deduction, tax savings. And then we'll go through a couple of examples, illustrations, and then leave time for questions and answers. It may not be appropriate in this environment to ask the specific question that you have, and we would love to talk to you about that privately, either email, phone, whatever. Follow up with us because we'd love to answer your questions. So I'm going to start, Tim, with just the basics of plan design, and I'm going to let you interject whenever you feel appropriate. But starting with the most basic is work with someone that knows what they're doing. And we specialize in small businesses and specifically small business plan design that maximizes the tax deduction as well as the contribution for the owner and their family. There are a lot of reasons to have retirement plans, and we're not going to go over any of the others other than just this specific one. So some of the basic plan designs questions that you have, do you want a Roth provision, safe harbor, new compensation, matching, profit sharing, a controlled group? You have questions about eligibility, entry dates, what is compensation, what's not included in compensation, vesting schedules, number of highly compensated employees, do you do it with a C Corp or an S Corp, last day provision. Those are just some of the elements that go into the plan design decisions up front and ongoing with the plan.
And Christian, if I may interject here, if I may interject, one of the things that we see time and time again is that too many plan sponsors have been sort of pigeonholed into some what I would consider a cookie-cutter plan. They're very, very basic. We've brought some of these things to the table and said, well, you know, what if we defined compensation this way? Well, what if we did this or what if we did that? And we give them all these illustrations. And one of the things we hear over and over again is, wow, I've never heard that before. And then I look at them and sometimes I'm thinking, you know, what we're talking about, this has been available for 15 years. This isn't anything new, but a lot of the older products and are just simple. And the other part that I always say is we will be as involved or as uninvolved as you want, so we can really get in there and really design a plan to whatever level. But getting those information is crucial.
So generally looking at retirement plans, we have a traditional 401k plans. We have the safe harbor 401k. We also have profit sharing plans, which have many different ways that you can flavor those. We have alternative plan designs. I'm sorry, I'm going to go back up before we start there. There's also other alternatives such as non-qualified deferred compensation, maybe for executives, ESOPs, those types of things. But again, we're only going to be focusing on the 401k and its counterpart, the cash balance. So I've got a couple illustrations, Tim, here. Before we go to them, do you want to set any of those up?
Sure, absolutely. Let's just go to that first illustration.
Okay.
Now in this one we had here's an illustration of a plan that we actually did a while back, and basically what we're looking at here is the sort of the basic start of the 401k plan. This was a plan that we had looked at, and this is what I would say might be considered a sort of the cookie cutter plan. When we got there, they were just doing the salary deferrals, and then they were just doing they weren't even doing safe harbor at the time. The plan was to get to the owner, which was Richard, but the plan was to get him to the $56,500. So we did that. Now, the important part about this is normally what we see in these situations is that people want us to give the most we can to the owners or the highly compensated in this case, which was Michaela and Richard up top, while giving as low amount as we can to what we call the rank and file employees or the non-highly compensated. in this instance, we ended up, if you look at that report summary there at the bottom, $58,500 was going to the principals, and $25,788 was going to the non-principals. So again, 70% of the money is going to the owners. Not a bad plan design.
Yeah, that looks pretty good to me. If I'm an owner, I'm thinking, well, 70% is going to me. That's not bad.
Right, but there's a lot of there are ways we can make it better. So let's see how we could make it better. So go to the next one.
Well, if I can get my computer to do what I want it to do, please hold. There we go.
Right. So what you see here now is the yellow. The yellow is what I changed, and the blue was the effect on the plan. So what I did now is I changed their plan to what's called new comparability. I put the doctor and his wife in two separate groups or categories, and then I lowered her profit sharing down slightly to keep her under 100% of pay. Those are the only two differences I made. And now what you can see is that the percent that I have to give the rank and file is now down to 9.78 on the profit sharing column. We lost $1,000 there, so it's $57,000 going to them now. But look what happened here. I reduced that to $17,000, which was closer to $25,000. Now 76% of the money is going to them. And if you go all the way to the bottom down here, this actually ended up being a $3,600 tax savings. Now this tax calculation.
How does that work, Tim? I mean, what you're saying is that the net is that it costs them to not do the plan?
In effect, I mean, we work with accountants, and this is let's just run down that each one of those numbers. So the employer contribution is $52,592 because we're not taking into consideration the salary deferral of the owner. So that's why that number is slightly different. So the estimated tax savings in a 41% tax bracket, and again, these are corporate taxes. It has nothing to do with your individual taxes. But by the time you get city, state, local, federal, everything under the sun, it's about 41% for most businesses in the United States. So there's going to be an estimated tax savings of $21,563. So basically what you have to say is that if you don't spend that $52,500 above, you're going to pay that $21,000. Now you can spend that $52,000 on whatever you want. Maybe it's to buy a new equipment for your business. But in this case, you're giving it as an employer contribution, so there's a tax deduction. So the third one down there is the net cost of the plan after estimated tax savings is $31,000. And then, but out of that $31,000, $34,700 are going to the doctor and his wife. So
they're getting paid with tax dollars, basically.
Exactly. Because, like I said, that $21,500 is gone either way. There is no. Because if you declared that $52,000 at the top, if you declared that as income for the company, you're going to pay that $21,000 worth of taxes. You're going to have to spend it somewhere or pay the tax. But since they're giving it to themselves and putting it into their own accounts, they're just giving themselves money. They're not spending it and actually losing it on a piece of equipment that depreciates at the end of the day. So we moved ahead to this next slide now. This is what we did on this one, is I thought, I think I could make this plan better. I mean, they were happy about that one. I said, but I can make it better. So I told Michaela to raise her pay to $25,000 because she was leaving some money on the table. So then and then I lowered her profit sharing to 5%. But you can see that she's still getting the salary deferral now, the full $17,500, safe harbor, and profit sharing. So she's getting plus the catch-up provision. 100% of her pay is going into the plan, and it dropped what I had to do for the rank and file again to 7.5. Now it's down to $14,700 on the report summary, and it's an almost $5,800 tax savings. While they're getting
we got that money back that we lost.
Oh, absolutely, absolutely. We got the money back, and then the other thing that we did is we also know that they had to, and then the $5,000 tax savings went up from $3,600, so that more than offset the additional payroll tax on the $25,000 that we paid Michaela.
Great. That's a win-win.
Right. Well, so then we thought, can we make this even better? In talking to them, I found out they had a couple of sons, and I said, well, let's bring your sons into the plan. And we did, but look what happened. It's like, man, the whole plan blew up. Yeah, we're getting because of their ages. You see, they're considered highly compensated because they're sons of the owner.
Right.
So we gave them $17,000 apiece, but look what we had to do to the rank and file. We had to give the rank and file 35% of their pay, or the part that you're highlighting there, $53,000. Well,
ouch.
The juice isn't worth the squeeze there. So, but I remembered as we reduced mom's profit sharing, things got better. So I said, let's reduce the son's profit sharing to nothing. So on this one, we completely excluded them from the plan, which you can do because they're considered highly compensated. Now, they're still getting their full $17,500 salary deferral. And I think it'd be great to be 25 years old and putting $17,500 away.
Right.
What we did is we excluded them from the safe harbor contribution and excluded them from the profit sharing. Look what happened to the rank and file, 1.66%, or $6,500.
And I want to make a point here, Tim. We're trying to do the plan design to maximize the owner and their family's contribution as well as the tax savings. I don't want it to make it sound like we're trying to be cruel-hearted and screw the little guy, but that's not what, there's, like I said at the first, there's a lot of reasons why you have a plan, but in this instance, we're not worried about, say, having the 401k as a retention tool or the profit sharing to incentivize the employees or something like that.
Well, that's a great point. And the other point is that if you look at this, if you look at these folks in the plan, the non-Hileys, they are not participating at all. So they're doing nothing for themselves, but they're all still getting $1,300. They're all getting thousands of dollars put into the plan for them.
Right.
As a free gift from their employer. And the other thing that's important here, Christian, is that we are designing this plan so this is the minimum they have to do. They can certainly do more.
Right.
If they wanted to do the 3% safe harbor, which is 3% of pay to everybody, and they wanted to do more than the $6,500 total, they can certainly do that. No problem whatsoever. This is just, but we want there to say this is the minimum you have to do, and you can see that this resulted in a $10,000 tax savings. So.
And I got to tell you, from a tax standpoint, I'm sitting here looking at that, and you talk about bang for your buck. On $60,000, I'm netting almost 11. That's a real good return on my money for not doing anything other than shuffling it around.
Right. So that's the same one that was just highlighted before.
I'm sorry. Okay.
No, you're fine. Go to the next one. So basically, what it boils down to is that if you add up all these, does this slide in at the bottom or no? If you add all of these things up, basically what we used to tell people is that those yellow numbers added together are well over $100,000, and that's so you can give over $110,000 to your family, and your cost on that's going to be the $6,500. And, oh, by the way, it really doesn't cost you anything because it's a $10,000 tax savings to your company.
That is crazy.
And I will tell you this, too. This is not uncommon. Okay, this isn't one of those illustrations where it's like, oh, let me pick out this one plan that I did this to. We could show you plan after plan after plan that are very, very, very similar to this.
So, Angela, what are the results of our poll, our first poll question?
Well, we had 50.
I'm putting you on the spot.
No, not a problem. 56% of the people did have a retirement plan, and 44% said that they did not. And that was with 100% of everybody voting.
Great. So, Tim, I've got another illustration I want to put up here, but let me ask you this. As far as what size of companies or type of company do you see get more bang for their buck. I understand it depends on facts and circumstances, et cetera, but when in general, is there an employee count that you start seeing less return, less bang for your buck?
Not really. I mean, usually what happens there is when you get into the larger populations, the percentages can go down, but just sometimes the dollar amount goes up. In this illustration that we still have up, we got this one down to 6% in the profit sharing. But if they had 75 employees that you're giving 1.66 to, all of a sudden, and like I said, let's say that the salaries were similar too, at $1,400 per head, all of a sudden 50, 60 employees can get expensive.
Right.
As a basis of percentage. But again, if a company has that many employees, they probably have that kind of revenue to offset it. So, but normally what we see is that that 5 to 25, 5 to 50 employer base is where really we see a lot of different. We would see a lot of bang for the buck.
Between the off-the-shelf standard cookie cutter that you were talking about and having custom plan design.
Right. And there are a lot of factors involved here. I mean, age is, I would say, the number 1 and 2 factor in the plan to do innovative plan design is ages and wages.
So I know we worked with some clients to do what I describe to my clients as kind of like the old pension plans where your employer put in a certain amount of money, and at the end of when you were ready to retire, you got an annuity or a lump sum amount when you left the company or when you retired. So this is a version of that. Tell us a little bit about a cash balance plan.
Yeah, cash balance plan, you're exactly right. It is a defined benefit plan, and it really looks and feels more like a defined contribution plan. Real quick, brief history. A defined benefit plan, what you're doing is just what it says. You're defining the benefit. I say, Christian, I'm going to give you $3,000 when you retire. I'm going to give you $3,000 a month for the rest of your life. So, I'm defining the benefit that I'm going to give you at retirement, and I have to figure out a way to actuarially calculate that and make sure we make the right investments over the years to make that happen. A cash balance plan still works in that similar way, but what I'm saying is, Christian, I'm going to give you a certain amount of cash inside this plan every year, and you're going to have a balance. And everybody in the company is going to have a balance of it, and it's going to grow in a very similar way. But so instead of defining the benefit, I'm going to give you cash, free gift cash, and and I'll keep a balance of it.
Okay. So tell us about this illustration that we have here.
Yeah. So what we're looking at right here is this is a very similar situation where we wanted to max out the owner. So the first thing you need to do is make sure that the 401k plan is maxed out as much as we can, and we did that. We have the partners in the plan. We're making sure that they've got the $22,000 in the 401k, the $32,500 in the profit sharing, which got them to their limit. And then what we do is
and let me interrupt you. I'm sorry.
Sure.
This was a medical practice, correct?
Correct.
Okay.
Right. And so then what we did is we added the cash balance plan on top of it. Lots of different interesting things you can do with cash balance plans. It's designed to benefit older, higher paid employees or owners. You can do a lot of exclusions. You only have to cover 40% of your population, Highlies or non-Highlies. Excuse me, 60%. So you can exclude 40% of your population. We don't see people do that a lot because they want it to be more fair, but that's what we normally we see on that.
So if I'm reading this right, we've got a total of almost $9 million that's a tax deduction for this company for this year, and all but $8 million of it are going to the owners.
Correct. Now, normally what we're seeing here is that some of that is salary deferral, so that's not all going to be. But if you take the like I said, some of that's going to be salary deferrals.
Got
so
it.
If you look at the profit sharing, yeah, I mean there's $2.6 million going into the 401k. So if you take you take the other totals there. So yeah, it's a significant amount of money that's going into the plan. And like you said, in this illustration, when we're having just a huge amount of money going just to the physicians and the partners.
Now this is obviously a large company as far as number of employees are concerned, but would this work with, say, a single owner with 5 employees?
It would. It really, normally what this is going to, cash balance plans make the most sense when the owner is probably north of 45. Under the age of 45, they don't make a lot of sense because the benefit peaks at age 63. But between the ages of 60 and 65, you can put away $1 million.
Wow.
Yeah.
Let me get that right. You can put back $1 million a year?
No, between the ages of 60 and 65. You
Okay.
could put away $1 million. It's a little bit, and again, it all depends on, you have to have extremely high wages. I mean, obviously getting close to that $250,000 income mark. The owners need to be, older, if not significantly older than the rank and file employees. And the company has to have good cash flow. And the reason that I say that, the only downside to a cash balance plan is the IRS deems them as permanent plans. And I love it that their idea of permanent is 3 to 5 years. So, but they're not a place to hide windfall profits. And once you sort of pick the funding level, you don't want to have huge swings in your funding levels either. Meaning, if using this as an illustration, we were talking about putting in, a total of $8.9 million going into this plan. We wouldn't want to see that go to $2.1 million the next year. That's going to trigger an audit because they're going to think that, hey, we did this to hide a bunch of windfall profits. So we need to have, high cash flow, very profitable, successful businesses are going to be who the candidates are for cash balance plans. But there's a lot of those.
So this is a continuation, I believe. No, this is a separate illustration.
Yeah,
so
this is just a separate illustration. I mean, you can see that you need to get, and this is a perfect example of when it makes more sense. Look at the 3 partners and their ages. The 62-year-old, his total cash balance was $214,000. But look at the 39-year-old, $62,000. Huge difference. And it peaks at age 62, and that's why I was saying you can see he's doing $214,000. He did over $250,000. So 62 to 60, that's why I said from 60 to 65, it's pretty easy to get $1 million put away if you're flirting with that 268 every single year.
And the way I'm looking at this here, I didn't have to do any cash balance contribution for the other, I guess, lawyers. And only $12,000 into the cash balance for all the other employees,
which was 34 of them.
Right.
Yeah.
And so 83% of this total went to the shareholders. That's impressive.
Yeah, like I said, I mean, yeah, it absolutely is. It's just a wonderful, wonderful tool, in the right circumstances. And you're right, with the ability to exclude people, with the ability to include others. You can have, like I said, the 39-year-old gets a lot less than the 62-year-old, even though he's a partner. All of these things are allowed inside here. It does take, we are going to have to get pretty involved. I mean, we're going to need complete and total census information and all the kind of stuff, really dig deep into these plans to get them to work. And they're not a fit for everybody, but this is what we do. This is our specialty.
And to be clear, there's no cost to gather this information and obtain illustrations to see if it makes sense, correct?
Oh, absolutely not. Yeah, I mean, we'd be more than happy to, they can get a census form from you, and we can do the plan design and have a similar meeting like this on a GoToMeeting format where we can look at the illustrations and compare and contrast. And the other thing I want to make clear, too, is that we're not going to come in and say, oh, we're going to try to sell you this one or sell you that one. Similar to the illustrations we went through before with the doctor and his wife, we just said, look, here's all your different options. Here's what the boy's in, here's what the boy's out, here's one with this, here's one with that. Just pick one. Which one is the best fit for your company? I don't want to say I don't care, because we care deeply, but I'm not going to force feed a plan design on anybody. That's why we call ourselves retirement plan consultants. Just which is the best one for you.
Great. Well, Angela, do you want to ask the final poll question, and then we'll open it up to questions and answers?
Yeah, that's a great idea. I'm going to launch that poll question now. And let's see how we're doing with questions in here while everybody's completing that. Let's see, I have a question here that says, I have more than one company. How does that work?
Well, Tim, I'm going to assume that we're going, not to be too technical, but we're going to be using the IRS attribution rules that you would to determine if the entities were related for tax purposes for the same way?
Correct. Yeah. What we'd have to do is we'd have to. There's different rules about what's called. Do we have a controlled group, or do we have what's called an affiliated service group, or do we not have either one of those? If we do have what's called a controlled group or an affiliated service group, then what you would have to do is you have to cover people in both of your companies, or however many that you have. This can open up the door for some interesting plan design, because you can have two different plans, but they still have to be tested together for discrimination, and there are some testings that have to be done together. Usually, to keep it simple, we just say, hey, let's just have one plan and cover everybody, and it doesn't matter if one's a movie theater and one was a car lot. We can cover both people in the same plan.
So the short answer is yes, you can if you have multiple entities, but you might not be able to exclude employees in one and only offer it to the other.
Correct.
Okay.
Depends on, yeah, and there's all kinds of different rules.
Okay.
I'm sorry, Angela, go ahead.
I have another question here. What happens if I can't make a contribution if I have a bad year?
Right. So that's a question I see a lot of times, Tim, where we set up the plan and things are going well, and then all of a sudden we got a train wreck of a year. 2008 happens, something like that, and I just don't have the money to put into the plan. What happens then?
Well, that's a great question. Some of the contributions that we illustrated, you do need to make. The safe harbor, if you say you're going to do a safe harbor, you should do the safe harbor. You actually can get out of it. It's a little bit messy. But the profit-sharing contributions are always discretionary. We can do a discretionary profit sharing. We can do a discretionary match. You can do it. You can put $80,000 in one year, nothing the next year, go 5 years without doing anything. We'll put as much flexibility and discretion in the plan as we can. Usually, if you want advanced plan design, the kind that was illustrated here, what you need to plan on is about 3% of payroll is kind of a gateway.
Now, let me ask you this. No one asked this, but I get asked this question a lot. Does that mean I have to give 3% to all of my employees? I mean, I got a lot of turnover, or I got a lot of part-time folks. I mean, is that 3% of everybody?
No, it's 3% of those who qualified for the plan. So you could do age 21, 1 year of service, and then you could do quarterly entry dates or semi-annual entry dates. So to give you I have to work 1,000 hours and be there a year and be over the age of 21.
Got it. So if I'm running
and you never have to give that to the highly compensated. So if you did have people that were defined as highly compensated, you can't exclude them from anything you want.
So like if you had a general manager that you were paying a lot of money, something like that. Okay. Angela, any other questions?
My question box is empty.
Okay.
All right. So if you guys don't have anything else, we can let these good people go and thank them. Did you have anything else to add, guys?
My only statement would be that, if you anticipate having a need for soon, reach out and let's have a conversation sooner rather than later. Doesn't mean you have to do something. It just gives you an idea of what your options are.
Very good. Okay.
Tim,
Well,
any closing thoughts?
No, like I said, I just appreciate you, letting us be a part of this webinar today, and I would just have to, reiterate again that this plan design options is something to take a look at. I'm just continually amazed how we are, the benefits and the things that we can do out there for business owners of all types and sizes, and don't think that a 401k is out of your reach. A lot has changed in the last, especially in the last 5 or 6 years with administration and compliance. Some things have gotten a little more sticky, some things have gotten a little more lenient, but there really has been what traditionally people with I only have 3 or 4 employees, I can't afford a 401k. Usually not true.
Great. And I would agree with that. I mean, I see a lot of people that are small employers or smaller companies, and they say, well, I got to have a simple. A 401k is too expensive. Yeah. Great. I appreciate your time, Tim, very much. Angela, we'll let you close her up.
all right. Well, thank you, gentlemen. Some great information. And for all of you on the line, we want to thank you for joining us today. If you do have further questions, please feel free to email us. Christian's email address is right there on the screen, and we'll be happy to help you. You will receive the link to request your free ebook copy of the Investment Answer tomorrow, as well as a recording of this session and contact information. It will come from the GoToWebinar system, so keep an eye out for that. If you don't get it and are still looking for it, just feel free to shoot us an email. We'll be happy to resend it. So thank you, everybody, and enjoy your day. Bye-bye.